Ryan earns $150,000 a year. Jordan earns $50,000 a year. In 20 years, Jordan has more money. Ryan has a nicer car, a bigger house, and a better vacation Instagram. But Jordan has the number that actually matters. And when you see exactly how this happens, you will never think about salary the same way again. Let's make this completely fair. Ryan and Jordan are the same age, same city, same financial starting point, zero savings, zero investments, zero debt. The only difference is the number on their paychecks. Ryan brings home $150,000 a year. After federal taxes, state taxes, and payroll deductions, his actual take-home is roughly $95,000 to $105,000 depending on his state. That sounds like a lot. It is a lot. Ryan knows it is a lot. And that is exactly the problem. Jordan brings home $50,000 a year. After taxes, his take-home is roughly $38,000 to $42,000. Every dollar feels accounted for. Every purchase gets a second thought. Jordan has never once felt rich. That is exactly his advantage. Here is the concept that changes everything. It is not how much you earn. It is the gap between what you earn and what you spend. That gap is the only number that builds wealth. Ryan's gap and Jordan's gap are not determined by their salaries. They're determined by their choices. And those choices follow a pattern so predictable, it has a name: lifestyle inflation. The moment Ryan got his $150,000 job offer, things started changing. Not because he decided to be irresponsible, because every signal around him said he had arrived. His apartment lease came up and he moved somewhere nicer. His car felt outdated, so he upgraded. His friends were in a different income bracket now and dinners cost more. His clothes, his vacations, his subscriptions, his everything quietly scaled up to match the salary. None of these felt like bad decisions in the moment. Each one felt earned. Ryan's monthly take-home is about $8,000. His rent is $2,800 for a one-bedroom in a good neighborhood. Car payment on a leased BMW is $620. Insurance, gas, and parking add another $400. Groceries and dining out run $900. Subscriptions, gym, and entertainment add $350. Utilities and phone land at $250. He puts $500 a month into his 401k because his company matches it and his coworker told him he should. That leaves him roughly $1,180 a month. Some months he saves it. Most months it disappears into things he cannot fully account for. He is not reckless. He is just living at the level his salary told him he could. Jordan's monthly take-home is about $3,200. His rent is $1,100 for a one-bedroom with a roommate arrangement in a cheaper part of town. He drives a 2014 Honda Civic he paid cash for 3 years ago. No car payment. Insurance and gas run $180. Groceries and dining out cost him $450. Subscriptions and entertainment total $120. Utilities and phone come to $180. He invests $800 a month into a total market index fund. That leaves him roughly $370 in true discretionary spending. Jordan does not feel wealthy. Jordan feels tight. But Jordan has a gap. Ryan's actual monthly investment is $500. Jordan's actual monthly investment is $800. Jordan is investing 60% more per month than someone earning 3 times his salary. Read that again. By year 3, Ryan has invested $18,000 total. His portfolio with average market returns is sitting at about $21,000. Jordan has invested $28,800 total. His portfolio is sitting at about $33,000. Jordan is already ahead, and the salary gap between them is $100,000 a year. Ryan's friends would never believe this. Ryan himself would never believe this. But the math does not care what you believe. Now, here is where the gap gets painful. Ryan gets a raise to $165,000 in year 4. He negotiated hard for it. He deserves it. And almost every dollar of it gets absorbed into a slightly upgraded lifestyle. New apartment, slightly nicer car lease, a few more weekend trips. His investment stays at $500 a month because changing it feels complicated, and he keeps meaning to get around to it. Jordan gets a small raise too, from $50,000 to $56,000. He does not upgrade his apartment. He does not get a new car. He raises his monthly investment from $800 to $1,050. Because in Jordan's world, a raise means the gap gets bigger, not the lifestyle. This is the moment that separates them permanently. By year 5, Ryan's portfolio is at roughly $35,000 to $40,000. Jordan's portfolio is at roughly $72,000 to $80,000. Jordan has more than double, on 1/3 of the salary. Ryan is starting to feel it. Not financially, his lifestyle feels great, but there is a low-grade anxiety that never fully goes away. He earns good money but does not have much to show for it in actual numbers. His net worth is mostly his apartment's furniture and the equity in a lease he does not own. He tells himself he will get serious about investing next year. Next year has been the plan for 4 years. Jordan is starting to feel something different. His portfolio crossed $50,000, and something psychological shifted. He can see the compounding starting to work. The gains on his gains are generating more new wealth than his monthly contributions. He is not sacrificing anymore. He is watching a machine run. By year 10, the story is almost uncomfortable to look at. Ryan has consistently invested $500 a month for 10 years. His portfolio is sitting at approximately $100,000 to $115,000. Jordan bumped his contributions twice more with each raise. He is now investing $1,300 a month. His portfolio is sitting at approximately $210,000 to $240,000, more than double. Still on a fraction of the salary. Ryan earns in 3 months what Jordan earns in a full year, and Jordan is lapping him. Here's what is happening underneath the numbers. Ryan's wealth is being built slowly because his gap is small. A large income with a large lifestyle leaves the same thin margin as a small income with a small lifestyle, sometimes thinner, because lifestyle costs scale faster than income. The BMW does not cost twice as much as the Civic. It costs 4 times as much when you factor in insurance, depreciation, and financing. The nice apartment does not cost twice as much. It costs 3 times as much and locks in a higher baseline forever. Every upgrade is harder to reverse than it was to make. Jordan's wealth is being built quickly because his gap is protected. He decided early what his lifestyle would cost, and he treats every raise as fuel for the gap, not permission to expand the lifestyle. That single decision, made once, compounds for decades. By year 15, Ryan has finally started getting serious. He bumped his monthly investment to $1,500 after a financial scare made him look at his actual numbers. His portfolio is at approximately $220,000 to $250,000. He is catching up, but starting from behind costs more than people realize. Jordan's portfolio at year 15 is sitting at approximately $480,000 to $540,000. He is on track to cross $1 million before age 50, on a salary that most financial influencers would call modest. By year 20, the gap is complete. Ryan's portfolio with increased contributions in the back half lands at roughly $400,000 to $450,000. Jordan's portfolio lands at approximately $820,000 to $950,000. Jordan has roughly double the wealth of someone who earned 3 times more money over the same period. Now, here is the part that makes this more complicated than a simple story about frugality. Ryan is not wrong to enjoy his income. A $150,000 salary that funds a rich life is not a failure. If Ryan is genuinely happy, debt-free, and not anxious about money, his choices are valid. Personal finance is personal, but most Ryans are not actually happy. Most Ryans have a lifestyle that looks wealthy and a balance sheet that does not. Most Ryans feel trapped by their own income because every dollar is already spoken for before it arrives. That is the golden handcuff problem. The salary is too high to feel poor, but too allocated to build real freedom. And most Jordans do not realize they have an advantage. They feel the constraint every month. They see the salary difference every year. They assume wealth is something that happens to people who earn more. They do not see that the constraint is the strategy. The real wealth killer is not a low salary. The real wealth killer is the belief that a higher salary automatically leads to more wealth, because that belief is what makes every raise disappear. That belief is what turns a $150,000 income into $500 a month of actual wealth building. That belief is what makes Jordan's $50,000 salary more powerful than Ryan's $150,000. There are 3 things Jordan did that Ryan did not. He decided what his lifestyle would cost before the money arrived. He automated his investments so the gap was protected before spending started. He treated every raise as an investment raise, not a lifestyle raise. None of these required sacrifice forever. They required one decision, made early, that compounded for 20 years. The next time someone tells you that you just need to earn more money to build wealth, ask them one question: what is your savings rate? Because the answer to that question predicts your financial future far more accurately than your salary ever will.